Is a new banking rule coming? And how could it affect you? Stay with us to learn more about this developing story. Before we begin, remember to like this video and subscribe for more economic updates. In an exclusive report, Reuters recently indicated that Swiss banking officials and lenders are discussing the possible application of extreme new rules designed to prevent bank runs. The reported discussions come in the wake of the shocking collapse of Credit Suisse and its subsequent acquisition by rival UBS earlier this year. Prospective rules being discussed by regulators include allowing banks to stagger withdrawals over an extended period and even impose fees on withdrawals. This means, under this rule, you wouldn't be able to access all your money and would actually have to pay to withdraw your money. How does that make you feel? The discussions, which are still in early stages, involve the Swiss National Bank and Swiss Finance Ministry. But the Swiss Finance Minister has denied these discussions. Keller Schutter said, "We are checking the entire too-big-to-fail framework and will publish a report about necessary measures in different areas next spring. But this measure, I can already say now, I don't know about and is not included." Referring directly to the report, the finance minister later emphasized, "This is totally wrong." Contrastingly, economist Peter St. Onge doesn't take the minister's denial at face value. Switzerland is considering locking people into failing banks using capital controls that would stop depositors from withdrawing their money. St. Onge points to the internet speed making bank runs worse, and the massive taxpayer cost of the Credit Suisse failure. The Economist explained that the Credit Suisse failure cost Swiss taxpayers $185 billion, which is equivalent to $7 trillion in U.S. population terms. St. Onge pointed out that with UBS's subsequent acquisition of the failed Credit Suisse, total UBS assets are about 448% of Swiss GDP, which is equivalent to roughly $100 trillion in US dollar terms. So it's not just too big to fail, St. Onge suggested, it's too big to bail out. Here in the United States, a wave of depositor anxiety about banking system instability led to the collapse earlier this year of First Republic Bank, Silicon Valley Bank, and Signature Bank, the second, third, and fourth largest bank failures in U.S. history, even exceeding the 2008 bank collapses when adjusted for inflation. According to the Federal Deposit Insurance Corporation, through the second quarter of this year, deposits at FDIC-insured banks fell for the fifth consecutive quarter. The decline in the first quarter of $472 billion is the largest quarterly decline on record. To our knowledge, there have not been any discussions among U.S. authorities about imposing these types of withdrawal prevention measures. Although, as St. Onge does not believe the Swiss minister, do we have trust in our own U.S. authorities? Of course, we will keep you posted as this story develops. Until next time.